What's going on, everybody? Welcome back to Trajecta Talks. I'm your host, Alex Savanovic. In our recent episodes, we've explored the intellectual challenges of finance, from trading psychology, as we discussed with Trading in the Zone, to the quantitative models driving AI. Today, however, we pivot to the equally vital task of keeping your money. So before we do that, let's do the market update. The market narrative this week was dominated by a high-stakes, highly volatile mix of mega-cap tech earnings, a cooling of the safe haven trade, and a quiet but important retreat in the US bond market, all set against the ongoing backdrop of a government shutdown and anticipation for a critical geopolitical meeting. So, more earnings reports this week from major consumer and AI exposed names provided a clear reality check to investors, leading to sharp price movements and even a bit of a correction yesterday and today. So, for Netflix, the streaming giant stock sold off by more than 6% in after hours trading despite robust revenue growth. The primary culprit was a significant miss on earnings per share, which came in well below estimates due to a one-time large tax charge related to a long-running dispute in Brazil. The market signaled its clear disdain for unexpected regulatory surprises, even as the core business revenue ad tier growth remained pretty strong. So Tesla's report also disappointed, with the stock declining as the company's automotive gross margin continued to shrink. Despite achieving record deliveries, partially due to a rush by US buyers to capitalize on an expiring federal tax credit, the profitability erosion coupled with an earnings per share miss overshadowed the top line performance. Investors are keenly watching if margin pressure can be offset by progress in its ambitious AI and FSD initiatives, a topic that management failed to sufficiently elaborate on. Two bellwethers for the AI infrastructure build-out, Vertiv, tickers VRT, and GE Vernova, ticker on that one is GEV, saw their shares trade down despite generally beating revenue and earnings expectations. The sell-off, which was sharp in both cases, appeared driven by two key factors: aggressive profit taking following strong year-to-date runs, and cautious forward guidance that did not fully live up to the sky-high expectations baked into their valuations. So this suggests that even the core AI trade is becoming highly sensitive to any sign of a deceleration in the pace of data center or power infrastructure spending. So the bit of a market correction from the earnings reports coincided with notable shifts in the fixed income and commodity markets. After hitting an all-time high earlier in the week, gold, you can take a look at the chart on GLD, that's one that I usually look at, plunged by its steepest margin since 2020. The retreat was widely attributed to a significant easing of US-China trade tensions and subsequent profit taking. As hopes rose for a thaw in the trade war, the safe haven appeal of bullion rapidly diminished. This drop in gold came as President Donald Trump and Chinese President Xi Jinping are set to meet next week at the APEC summit. Markets are in a state of elevated anticipation, with investors attempting to price in potential outcomes from the high stakes talks, which could either alleviate or dramatically escalate the existing tariff regime. Only time will tell. Cues from both sides suggest a possible temporary de-escalation, hence the recent shift out of safe haven assets. Quietly, the US 10-year Treasury yield slipped below the critical 4% threshold, a move suggesting investors are concerned about the underlying health of the US economy. This decline in yield is being driven by continued deterioration in US labor statistics, with initial unemployment claims and revision to past payroll data painting a picture of a softening job market that is not collapsing but steadily losing momentum. This macro data strengthens the argument for the Federal Reserve to continue its easing cycle. So, compounding the economic uncertainty, the US federal government shutdown that began on October 1st continues with no legislative solution in immediate sight. The shutdown is now the longest under President Trump's administration, furloughing roughly 900,000 federal employees and withholding the release of key economic data, such as the CPI report, which further clouds the Federal Reserve's decision-making process and adds a persistent layer of risk to market sentiment. We're going to be watching the Trump and Xi meeting next week closely, as its outcome is likely to set the direction for global equities for the remainder of the quarter. Now, that's the end of the market update. Let's get right into our episode. Today, our topic is fees. Fees are the silent, relentless friction that work against every financial decision that you make. They are the single greatest passive destroyer of long-term wealth, often taking a seemingly small cut today that compounds into hundreds of thousands of dollars lost over a lifetime. Whether you're investing in an ETF, buying your first home, or purchasing a car, a hidden system of costs is constantly trying to extract value from you. In this episode, we're We're going to pull back the curtain on this system. We'll break down every type of fee from financial products to major transactions, explain exactly where your money goes, and most importantly, equip you with the knowledge and tactics to negotiate these fees down or eliminate them entirely. So let's turn the focus from making money to protecting it. So we're going to start our discussion with investment products because this is where fees can silently compound and erode your returns for decades. Historically, mutual funds have been notorious for high and complex fee structures. When you invest in a mutual fund, you typically encounter a few different layers of costs. Number one, the expense ratio. This is the core fee expressed as a percentage of the fund's total assets that is deducted every year. It covers the fund's operating expenses, portfolio management, administration, and distribution. So a typical actively managed mutual fund might have an expense ratio of 1% to 1.5%. I've seen them sometimes as high as 2%. If you invest $10,000 and the market returns 7% that year, a 1.5% fee means you earned 5.5%. That difference, compounded over 30 years, can reduce your final portfolio value by 30% or more. This is the silent killer. You never see the money leave your account. It's simply deducted from the returns before you get them. Next are load fees. These are the sales charges paid directly to the broker or advisor who sold you the fund. So there's a front end load, a commission paid when you buy the fund. This might be 3 to 5% of your investment. If you invest $10,000 with a 5% front load, only $9,500 is actually invested. There's also a back end load. This is a fee paid when you sell the fund, usually decreasing over a period of years. For example, let's say 5% if you sell in year one, 4% if you sell in year two, et cetera, et cetera. This is sort of designed to lock your money into that mutual fund. Next is a 12B-1 fee. This is an annual charge, typically 25 basis points to 100 basis points that funds are allowed to deduct from assets to pay for distribution and marketing costs, including compensation for the brokers who sell the fund. So now let's talk about ETFs. The low-cost disruptor, ETFs or exchange-traded funds, have largely disrupted the high-cost mutual fund industry, and for a very good reason. The first reason is lower expense ratios. ETFs, particularly those that track a major index like the S&P 500, are passively managed. This dramatically lowers the operational complexity and the cost. It is now common to find high-quality index ETFs with expense ratios as low as 3 basis points to 5 basis points. That's a 30th of the cost of an expensive mutual fund. There are also no load fees for an ETF. ETFs are traded on exchanges like stocks, meaning they do not carry front-end or back-end load fees. When you buy or sell them, you may pay a tiny commission, though most major brokers now offer commission-free trading on ETFs or stocks, bonds anyway. Next is advisory fees. The AUM model, if you use a financial advisor or wealth manager, you will typically pay an asset under management fee. This fee is a percentage of your total portfolio value, usually ranging from 50 basis points to 150 basis points annually. So the challenge with an AUM fee is that the advisor is paid the same percentage whether your portfolio goes up or goes down. Furthermore, their fee grows as your assets grow, but their workload does not necessarily increase. For a large, simple index portfolio, paying 1% in AUM fees is an enormous drag on performance that should be scrutinized heavily. This is often the most negotiable fee in the financial industry. So now let's talk about, where do the fees go? Understanding where the fees go helps you understand which ones are justified maybe and which are simply profit extraction. Fees are generally divided into 3 categories. First one is management fees. That's the, I guess you could call it the intellectual cost. This component covers the salaries, research, and infrastructure required for the investment decisions. For actively managed funds, these fees are high because you are paying for the expertise of a portfolio manager and their team who are actively researching, buying, and selling assets, trying to outperform a benchmark. If they succeed, the fee is arguably worth it. And if they fail, which most active managers do over the long term, the fee is a cost of underperformance. So for passive funds like ETFs or index mutual funds, these fees are minimal because the manager simply programs the computer to buy the assets in the index. There is no need for deep research or active decision making. There are also administrative and operating fees. Obviously, those fees cover the mundane but mandatory costs of running the fund. You have things like custody, safekeeping the assets with a reliable custodian, legal, compliance, for ensuring the fund adheres to all regulatory requirements and tax laws. You have to pay for accountants, auditing. They have to prepare financial statements. Sometimes you need a transfer agent that's used for processing shareholder transactions. That's like purchases and redemptions. There's also distribution and marketing fees. That's sort of the sales cost. These are the fees dedicated to selling the actual product. As discussed in part one, this is where the 12B-1 fees and load fees fall. The load fee is a direct payment to the sales force, broker, or advisor for bringing you into the fund. This is essentially a commission. The 12B-1 fee deducted annually pays for the ongoing marketing and distribution costs to keep the fund visible and attractive to investors. So the bottom line, if a fee is going primarily toward distribution, you are paying someone else to be sold a product. If a fee is going primarily toward administration and passive management, as in low-cost ETFs, it's the necessary cost of efficient operation. So we always favor the latter and make sure you're reading the fee structure, scrutinizing it heavily. So now let's move on from financial products. Outside of the financial world, some of the largest fees you will ever pay are associated with purchasing major assets like homes and cars. These are not percentages skimmed off of a return. They are hard dollar costs paid up front. They're way more in your face than the fees that are sometimes hidden in a mutual fund or an ETF. So let's talk about real estate first, the commission giant in today's world. When you buy or sell a home, the fees, known as the closing costs, are staggering and mandatory, though they're often very negotiable. So real estate commissions are often the single largest fee in the US. It traditionally sits between 5 and 6% of the property's sale price. This fee is paid by the seller, but it is split between the seller's agent and the buyer's agent. On a $500,000 home, that's a $30,000 fee that disappears from the transaction. The commission structure is currently undergoing significant changes, particularly in the US, but it remains a massive expense. We also have the buyer's closing costs. Even after the commissions are paid, the buyer is hit with an assortment of fees. You have title insurance, which protects the lender and you against any challenges to ownership. You have an appraisal fee. That sort of just confirms the home's value for the lender. Definitely going to have some legal fees, maybe an attorney or escrow fees for handling documentation. There might be land transfer taxes and recording fees. These are government mandated taxes for recording the sale. You might also have lender origination fees, a fee from the bank for processing the loan, usually 50 basis points to 100 basis points of the loan amount. So moving away from homes, let's talk about automobiles. Car buying is an exercise in resisting small, often unnecessary fees that pile up. Dealers rely on consumers focusing solely on the monthly payment or the sticker price, ignoring the add-ons at the end. So dealer documentation fees, these range from a few hundred to over $1,000 and are supposedly for paperwork or processing. In many jurisdictions, these are legally capped or simply pure profit. You also have financing fees, if you can believe it. If you finance through the dealership, they are often paid a commission, a fee, by the bank for steering you to that loan, and they may be marking up the interest rate that they offer you. There's also so many add-ons. Be vigilant against fees for things like rust proofing, paint protection, VIN etching. These are almost pure profit for the dealership and are almost never worth the cost. They're going to charge you an exuberant amount, and I promise you can go somewhere else and do it for a fraction of the cost if you really want to do it. So how do we fight back? The biggest lesson about fees is this: most fees are negotiable, or they are avoidable by choosing a superior product. Your primary goal should always be to reduce the friction in your financial machine. So negotiating financial fees, avoid high cost products. Simply refuse to buy mutual funds with high expense ratios or load fees. Stick to the low cost index ETFs where the expense ratio is often less than 30 basis points. I've seen some as low as 5 basis points. The difference between 150 basis points and 5 basis points is often the difference between financial success and mediocrity way down the road. Challenge your advisor. If you use a financial advisor, ask them to justify their AUM fee. If you have a simple index portfolio, push them to lower their fee from 100 basis points to 75 basis points or less. If they refuse, Look for a fee only advisor who charges a fixed hourly rate, or a robo advisor with AI. There's tons of those now for passive index management. It's truly just a computer if it's passive. Eliminate the trading commissions. Most major brokers offer commission free trading for stocks and ETFs. If your broker is still charging you, definitely time to switch. Negotiating real estate and big purchase fees, commissions are negotiable. On the sale of a home, the listing agent's commission is almost always negotiable. Instead of 6%, negotiate for 5 or even 4.5. If the market is hot or the home is high priced, $5,000 savings on your commission is $5,000 in your pocket. Maybe you go to a nice dinner. There's also lender origination fees that we talked about. When getting a mortgage, banks will often offer a lower interest rate in exchange for paying points, a fee. Sometimes they will charge a non-negotiable origination fee. Always shop around and ask competing lenders to match or beat a competing offer. You can often negotiate to have a portion of your closing costs covered by the seller or the lender. So car dealer fees, I know everyone listening to this kind of knows this already. These are the easiest to negotiate. When buying a car, follow these steps. Negotiate the price of the car first. Do not talk about your trade-in or financing until the final sale price is settled. When you see a document or dealer fee, question it aggressively. Ask, what exactly am I getting for this $599 document fee? And if they can't justify it, ask for it to be removed or reduced. Do not pay for dealer add-ons like etching or paint protection that we talked about earlier. Go do it somewhere else if you truly think that you need it. I don't personally think it's that important. So in conclusion, the path to wealth is paved with fee avoidance. And I know that sounds silly, but it really is true. The takeaway today is simple. Every single dollar you save in fees is a dollar that remains in your portfolio to compound and work for you. In the world of finance, we constantly look for a small edge all the time, a few basis points of alpha. In your personal finances, eliminating a 1.5% fee is the biggest, most guaranteed alpha you will ever find. Be vigilant, be informed, and be prepared to negotiate. Do not allow the industry to passively siphon your wealth through convenience. Take control of your costs, and you take control of your future. Now, before we wrap up the episode and do the little outro, we do have some stock picks to talk about. We're starting up with a follow-up on last week's pick, which turned out to be a fantastic entry. Great trade by Miles. Miles, congratulations. Last week, he submitted his buy on Ford Motor Company. Ticker symbol is just the letter F, with an entry price of $11.47. As of this week, Ford is trading at $12.46, I think I saw today, roughly around there. So he's up about $1. It's a perfectly timed trade on the auto sector dip. Well done, Miles. I'm not sure where Ford is after hours. Maybe it might be tracking Tesla a little bit on the sell-off on the report, but Miles, if you sold it before the close, you would have made $1. Now, for this week's new submission, which comes from Frank F., he's taking a much more bearish stance and looking at the high-flying defense sector. I don't think we've had a defense sector pick yet. Maybe we did. Maybe there might have been someone Boeing a long time ago. So Frank says short sell Northrop Grumman. That's NOC. His entry price was exactly 600. I think it was 599.98, but let's round up to 600. This is a bold contrarian move. Frank is betting that NOC, a major aerospace and defense contractor, has hit a peak. Shorting at a big round number like $600 maybe suggests he believes the stock is overextended, due for a significant pullback. This is a tough trade against a very strong sector, but it will be a fascinating one to watch. I'm wishing you the best, Frank. Thank you for the submission. We'll check back in next week to see if this bearish bet starts to pay off. And folks, that wraps up our deep dive into the invisible world of fees. I hope this discussion empowers you to challenge every cost that comes across your desk. To stay connected and continue your learning journey, be sure to follow us and our sponsor, Trajecta University. That's Trajecta University. Find us on Instagram, LinkedIn, Facebook, also TikTok now by searching for Trajecta University. Also check out our YouTube channel at Trajecta_talks, where you can watch this episode and find a ton of other great content. All the links are in the show notes down below for you. So make sure you join me next time as we continue our conversation about building your financial future. Until then, keep learning, keep investing in yourself, and keep building your future. Have a very happy Friday. Take care, folks. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.